There isn't this panacea of money on blockchain that you can't get to anywhere else. Money is really smart. It can get to whatever it wants to. It doesn't need the blockchain to do that. And so in the beginning, you're introducing something different that introduces friction. And so, in the beginning, it isn't that it's cheaper for me to finance XYZ on blockchain or trade PDQ on blockchain or whatever it might be. It's actually, in a lot of circumstances, going to be more difficult to do it. But in the long run, it will make sense.
Hi, everyone. Welcome back. My name is Steve Ehrlich. I'm the executive editor at Unchained. And in this particular segment is going to be the Bits and Bips, the interview.
Are you a builder who needs to add on-chain trading to your product? The Uniswap Trading API from Uniswap Labs offers plug-and-play access to some of the deepest liquidity in crypto. It's on-chain execution at an enterprise level. More liquidity, less complexity. Visit hub.uniswap.org to learn more.
I'm here with Mike Cagney, founder and CEO of Figure. And we're here to talk about Figure's, I think, really terrific year. Successful IPO, and they've really found product market fit with regards to putting HELOC loans on their own blockchain called Provenance. I wanted to speak with Mike to kind of get a sense of what the year has been like for him. Now that tokenization has become a very hot topic again, sort of what helped him succeed when, frankly, a lot of tokenization products or projects that have been around over the last 10 years have failed, and kind of what the future of tokenization means for his business. So welcome, Mike. Thanks for joining us.
Oh, thanks for having me. Great to speak with you again.
So yeah, let's just, it's funny. Sometimes when I talk to people about Figure, most people in crypto probably don't own homes yet. They don't know what a HELOC is. And when I use that term, they look at me like I'm speaking gibberish. So can you just briefly explain what a HELOC is and why it's a product that's very well suited to be tokenized?
Sure. So a HELOC stands for home equity line of credit, and it's effectively an open-end mortgage. So generally, when we think about mortgages, we think about getting a 30-year fixed rate mortgage, and you're paying principal and interest every month. And at the end of 30 years, you pay the loan off. A HELOC is also a mortgage. It's secured by your home, but it's open-ended. So, I might have a $100,000 HELOC. I might pay $50,000 down, and then I can borrow the $50,000 back up again. And a lot of people think of HELOC as a second lien product. So there's a mortgage, and then behind that, there's a HELOC. But one of the fastest areas of growth that we found is HELOC in the first lien position. So using it instead of a mortgage. And one of the things we've been able to do over time is get the rate on that HELOC in first lien position to be comparable to Fannie and Freddie rates for conventional mortgages. And this has been a huge advantage for us in mortgages under, say, $300,000, because the way the industry's evolved to do a Fannie Mae or a Freddie Mac eligible mortgage costs about $13,000. And so if it's a $200,000 mortgage, $13,000 is 6.5 points. There isn't a market you can sell the loan in for 6.5 points. Because of the efficiencies we captured through blockchain and the capital markets that we built out through blockchain, costs us less than $1,000 to produce that mortgage. And so, we have over 250 partners now that use our technology to originate loans, including 10 of the top 20 mortgage companies. And the fastest area of growth is HELOC and first lien position for these sub $300,000 balances. And we think that's an area that has huge opportunity. It's almost greenfield because no one was doing those loans before because you couldn't do them profitably. So even though it's in the mortgage space, which we think is relatively saturated and competitive, that's actually a greenfield domain that we've been able to lean in on and grow.
Gotcha. Maybe, forgive me, maybe you could just explain that a little bit more. I'm familiar with HELOCs. I have one on my home, but it's really kind of taken out as maybe just an emergency fund in case I need something, or if I know people take them out if they want to perhaps do an addition on their home or some type of renovation. And but it's always, again, like a backup plan or a secondary source of funds. Can you just explain really what it means for it to be almost like an actual mortgage replacement? Because I frankly hadn't heard that before.
Yeah, and that was why when we started Figure, we wanted to bring a tangible solution to market, and we chose credit. We said we could originate, aggregate, securitize assets on blockchain, save 85 basis points of cost, and we needed a credit vehicle we could originate that. I knew that it would be a Herculean task to convince the buy side to start using blockchain, the sell side to start using blockchain. And so I didn't want to fight it out with SoFi on personal loans or Rocket on first lien mortgages. And the area to me that I thought was relatively untapped was home equity line of credit, because historically it's been used for exactly the reason why you have yours, right? It's the rainy day line of credit. And I can tell you, in the lending world, you don't like lending to people when it's raining out. You like lending it to when it's sunny out. So, what always stuck with me when I was at SoFi, we would sell huge pools of unsecured consumer loans, and our borrowers tended to be prime. They tended to own homes. They tended to have a decent amount of equity in the home. And the question we always got from the capital markets was, why aren't they taking a HELOC? Why aren't they taking the second? Like, why are they taking this unsecured loan? The rate's much higher. The reality is they're doing that because the process was so much easier, right? We could underwrite an unsecured loan in a couple of minutes and fund literally that day, versus the HELOC process, which was the same as the mortgage process, which was 45 days of misery, right? You're producing income statements and tax returns and all this stuff. And so we felt that if we could bring the personal loan efficiency into the HELOC marketplace, we could actually get people who wanted to take the loan out for immediate purpose. And so what's unique about this HELOC is when you take a $100,000 HELOC from us, we're dispersing $100,000 to you. Now you can pay that down and pay it back up. It's an open line, but it's a fully dispersed loan at origination. And so it's really oriented more towards an immediate use case, right? Not, I'll draw it when I need it. And again, what's interesting is the first lien product. So using a HELOC and first lien, that's actually prevalent in other countries. Like Australia, that is what an Australian mortgage is, right? It isn't a 30-year fixed product. It's an open line that you draw against your home because it's cheaper to do that than on an unsecured basis. And so, we felt that we would have a lot of appetite for it. We also felt it had some virtuous credit signaling, because if you had a borrower who could take an unsecured loan or, put their home up as collateral and get a lower rate, whether they're going to pay the loan or not, which one they choose tells you a lot of that. And so, it ended up being a great asset class for us to start with, because nobody was doing it the way that we do it. And it really provided a lot of incentive for the buy side to lean in and start taking that loan down.
Okay. So let's just, again, because I want to make sure everyone watching and listening stays with us for the whole conversation. Can you just briefly walk me through like the life cycle from, I guess, origination to disbursement, to, I guess, the loan being sold through your blockchain to your capital market partners, so that everyone kind of has a visualization in their mind of how this works?
Yeah, I'll do that, and then I'll talk about some of the challenges that we had early on because of blockchain, and I think this is illustrative of why a lot of these RWA projects haven't taken off, because of some of these challenges, and I can talk through how we navigated that. But basically, what we do is we ingest the data from the loan, so credit, title, property, income, directly into the blockchain. And by the way, one correction, that we use a blockchain called Provenance, which we built, but we don't own. It's a public chain, so it's public blockchain. And the importance of that is the blockchain is immutable. And so what happened in 2008 was a bunch of lenders got in trouble because they would go in and modify loan documents, modify income numbers, modify loan to value numbers. And it created a lot of uncertainty. And the rating agencies coming out of that said, you know what, going forward, to get a AAA rating on a mortgage deal, we have to audit every loan, and it's $500 a loan. That's the scope of the audit. Well, because of the way we ingest data into blockchain and the immutability of that, the rating agencies have lowered our requirements down to 20 to 30% of the loans and about $100 a loan. And so this manifests to, a couple $1 million of savings per securitization transaction, per AAA rated deal, which is about 50 basis points, in terms of the cost of the life cycle. But effectively, We originate the asset native on chain. So the loan is on the blockchain. We pledge that asset into a warehouse provider, like a Goldman, for example. Although this is changing because we're starting to use DeFi. We could talk about that as well. But we pledge into a warehouse provider. And one of the things that I've been pushing Goldman on for years was, look, you should take the loans on chain. You should use Dart, which is a registry service that we have to encumber those loans. Because the way we've historically done warehouse pledging is I send a spreadsheet to the bank full of loans. They send me a bunch of money, and then they spend 5 days figuring out if I lied to them or not, right? And sometimes they can't figure that out. And the Tricolor was a great example of this, where there was a massive amount of fraud. Well, you can't have that fraud on blockchain. And when Goldman finally started using it and realized, hey, we don't need to spend 5 days. We know immediately whether you gave us the loans or not. We've de-risked this transaction, meaning not only can we get you the money faster, we could actually give you more money, meaning we make more money. And we don't have a staff that has to do all this reconciliation. They really leaned in and embraced it. And our warehouse providers and partners all leverage that now. But we aggregate these loans up, and then ultimately they're sold into either portfolio buyers like insurance companies, or they're securitized, where they're aggregated and turned into debt. The servicing, subsequent cash flows all happen on chain. And the importance of this is, we think about, like, why do we use blockchain? There's 3 reasons why we use it. One is we get some transactional efficiencies at the top, like the AAA rating cost, or the warehouse pledging costs. And we've been able to capture over 100 basis points of efficiency out of that. We get liquidity, but liquidity doesn't come on its own. There's a misrepresentation of blockchain that, if I put something on blockchain, it becomes liquid. And obviously that's not what happens. For liquidity, you need ubiquity and homogeneity and market making and all these other things.
I know when you spoke. I was going to say, I know when we spoke in the past, like that was the issue that plagued many other tokenization projects. Like you can do the initial issuance, but then you don't have this liquid secondary markets.
Yeah, 100%. And this is why there's a lot of projects that are well intended, putting private company stock on blockchain. Well, of course you could do that, but there isn't a reason that it's going to trade persistently, right? Or putting an office building on blockchain. Well, sure, you can do that, but who's going to trade it? And I think I've joked with you before. This is why I don't get invited to RWA conferences, because I always say these are stupid ideas. But the construct is, we've created a liquid market because all the remittance data, the principal and interest payments, come into the blockchain. And so I have a pool of loans that are all have a common agreement in terms of buying and selling, and that I see real time whether they're performing or not. And that's created liquidity. So, if you go to CoinGecko, for example, I think we're the 11th largest crypto asset by market by TBL. So I think we're behind Dogecoin and ahead of Cardano last I looked, but somewhere in that neighborhood. But you see our volume every day, and it's hundreds of millions of dollars of loans to trade because of this efficiency that we create in this liquid marketplace. But the real value prop to me is DeFi, and it's connecting sources and uses of capital directly. And what we started doing last year is we started saying, well, look, what if we bring some loans over to DeFi? Because DeFi historically has been crypto, right? Because for DeFi lending to work, the asset has to be liquid. This is another limitation that folks have and don't fully understand, because you're doing an asset-based loan. So you're not underwriting the asset. You're actually underwriting how liquid it is, how volatile it is, and what the advance rate is. And so we brought $10 million of loans over and financed them cheaper than we could in our warehouse. And we brought another $10 million over and did it again, and brought $100 million over, doing it now. Now we're going to bring $1 billion over, and we're going to start migrating more and more of the capital structure to decentralized finance. And go ahead.
When you say DeFi, I'm curious if you could just be a little more specific on which platforms. I mean, is it just like open DeFi, or I know like groups like Aave, Compound. I mean, they have like institutional like walled garden versions of DeFi.
Right. So we have a DeFi platform called Democratized Prime, which is open, although KYC'd. But we recently launched on Solana a platform called Hastra. And Hastra is effectively an open protocol that People buy wrapped yields on Hastra, which is our yielding security, but wrapped in Solana, pledge it into Hastra. Hastra applies capital into our DeFi protocol to generate yield, and then that staking token can be looped on Camino or traded on Radium. So it is actually in the broad DeFi ecosystem. It's not in a walled garden. And what's interesting about that is that activity lowers mortgage rates for U.S. consumers. So you think about, on Camino, they prevent U.S. users from participating. So we have a bunch of non-U.S. capital that is participating in actually lowering the cost of mortgages to U.S. consumers coming through this DeFi construct, which is why DeFi is so important to me. And I think, one of the things I've been doing recently is advocating for the market structure bill around protections for DeFi. And, what I can bring to the table that's a little unique from some of my peers is tangible use cases to senators, how this helps their constituents. So like Warnock, from Georgia on the Democrat side, we funded over $1 billion of loans in Georgia, and his constituents saved money because of DeFi, right? And so we've been advocating very hard on that front. And but effectively what I think ultimately happens is I think you're going to get a migration out of bank deposits on the Genius Act because of the stablecoin legislation. I think that money gets reapplied into DeFi, and I think what you're going to see is assets and liabilities move from the bank balance sheet onto a DeFi protocol, and that's what I'm most excited about.
I am too, and we're going to talk about that in a lot more detail. But first, we just have to take a quick break to hear from some of our sponsors.
Hey, founders and developers. If you're looking to bring on-chain trading to your product, wallet, or platform, check out the new Uniswap trading API from Uniswap Labs. It's your plug-and-play gateway to global on-chain liquidity. No deep crypto experience required, and no need to manage complex integrations or ongoing maintenance. With the Uniswap trading API, you'll get enterprise-grade on-chain execution, combining both on-chain and off-chain sources for the most competitive prices. Simply put, more liquidity, less complexity. And this isn't just any API. It connects directly to the Uniswap protocol, which has securely processed over $3.3 trillion in total volume with zero hacks. So stop worrying about liquidity infrastructure and focus on building your product. Get access to the same liquidity that powers billions in swaps through one powerful API. Visit hub.uniswap.org to learn more.
Okay, Mike. So before we left off, you started getting into what's happening in DC and sort of how it's important to get legislation right in order to kind of clear the pathway for products like yours that have product market fit. But first, I just want to ask one other quick question about the mechanics of how this works before we get into that. Stablecoins. When people, when investors, you issue the money in fiat dollars, I guess, to the HELOC participants. When people buy the tokenized securities, when you securitize the loans, are those done in fiat or are they done in stable coins? And I know that you recently launched your own yield-bearing stablecoin. You actually registered it with the SEC. But when I checked, I saw uptake is still small. It's early. I think it was like $3.4 million market cap. I think
we're at a couple $100 million in market cap right now. So you might have been looking at some stale data. So it's growing. It's starting to take off. And what we're doing is, if you think about our ecosystem, there's loan funding, which we're still funding in dollar fiat, and unless users elect to be funded in stable. There's the pledging to the warehouse, where we're now migrating that to using stable coin. So rather than when I pledge the loans, Goldman sends me a wire for dollars, I'm starting to pledge the loans and Goldman sending me yields, which is our stable coin, our yielding coin. There's loan sales, which we're also migrating to stablecoin settlement. So, I sell Apollo $200 million of loans, or you're sending me $200 million of stablecoin. Again, yields. And the securitization is kind of the last leg, where what we'll start doing in 26 is issuing those securitization bonds native on chain. Because today we don't. Today, other than some limited exceptions where we have done some on-chain issuance, generally we've been issuing those securities in traditional form, as DTCC registered securities. what you'll start seeing in 26 is blockchain native issuance, and that will then allow for stablecoin settlement. So there's no asynchronous process of a wire versus the security settlement. So, reducing the post-trade audit and reconciliation expense.
And which stablecoin is that? Your stablecoin or is it USDC?
So we use yields within our ecosystem, although yields is convertible into USDC 24/7. And so, that marketplace is always open. But we tend to use yields because it affords us some benefits that traditional stables don't afford, including the interest that it pays.
Gotcha. And I am curious too. I mean, given how much you work with Wall Street banks, I mean, what kind of conversations are you having with them about their own stable coins now that we're in kind of a post-Genius world, even though the law hasn't been fully enacted yet, and tokenized deposits, which from my perspective, I know all the benefits of stable coins, but for like regulated financial institutions, tokenized deposits seem to be a much more capital efficient tool. Maybe there's additional savings there that could be passed over to your customers.
Yeah, I'm not sure how valuable the tokenized deposits are, and only in the sense of the way I look at the stablecoin ecosystem is, stablecoin is not proliferated the way that we expected it to, because it doesn't really have utility, right? Like I can't go to Starbucks and buy coffee with stablecoin, and so that limitation, both limits its use cases and also limits its disruptive capability and value creation capability. The Genius Act's going to change that. And what we're seeing is JP Morgan leaning in pretty heavily around the idea of building a new payment rail or payment infrastructure. They just moved JP Coin off of their proprietary blockchain, which was a forked version of Ethereum, onto Base, which is, obviously an L2 EVM. But they're going to move it into broader Ethereum mainnet, I'm sure. And you're going to see what I think is JP Chase versus the rest of the world. And JP Chase looks at interchange and says, look, we've got an issuing processor, an issuing bank, Visa, MasterCard, merchant acquirer, merchant bank. Why do we need the issuing processor, Visa, and the merchant acquirer? Like, why don't we just have an issuing bank, us, and a merchant bank, us, and we trade on our rail? And I think they're going to lean in and do this, and I think it's going to bring utility at least into that version of coin. And I think if I'm a regional or super regional bank, this should be an absolutely terrifying idea to me, because they're going to come after my liabilities and they're going to get it, because they're going to be able to offer stablecoin value that I can't do. And a tokenized deposit isn't a defensive mechanism to that, because I'm not going to be able to use it as utility, right? I'm not going to be able to go buy Starbucks coffee with a tokenized deposit. So, I think that the rest of the banks have to think about, do we build around a common coin that's a little bit like herding cats, trying to get, every other bank to lean in to do that. We think yields is an actually interesting opportunity for the banks to lean in and support, because, yields is defensive against JP Coin because it pays interest, and yields, we can hold treasuries or bank deposits, so we can keep the liabilities of the bank from their customers on their balance sheet. And so there's a value prop off of that. So I think it'll be really interesting to see, how this evolves. But what I can tell you is, the sell side in particular, the big banks, the Goldmans, the Morgan Stanleys, and certainly the JPs, they are moving into blockchain and doing, in my mind, much more innovative and disruptive work right now than, the Coinbases of the world are. And this has been interesting to me to see. And I saw this firsthand because, we have an S1 about issuing figure stock native on blockchain. We put it out a couple of weeks ago, and we're hoping that we do this. I call it a second IPO, although it's all secondary. It's not primary, but doing it in January. And, the speed at which the large institutions, if you look at the S1, JP and Morgan Stanley are on the cover. They're underwriting the deal, right? Goldman and Morgan Stanley. I had a brain cramp there saying JP. Goldman and Morgan Stanley are on the cover, and they're underwriting the deal. And, they understand the potential disruption of this and, eliminating DTCC, eliminating NASDAQ, replacing prime brokerage with DeFi. this is a wholesale replacement of an equity capital market piece. But the traditional blockchain players or crypto players, I don't think understand or have been as aggressive leaning into this opportunity set. And, that's been a little bit surprising to me, but maybe not, because I think, again, with the legalization of blockchain and crypto, I kind of view it when I started SoFi, I went to the very first Lend It, and it was like the bar scene out of Star Wars, right? It was the weirdest group of people that you'd ever see. And it was just insane. And 2 years later, it was just all suits. And so I think we're at the all suits inflection point that's about to happen in blockchain. There's been a lot of people lamenting about this on crypto Twitter. But I think it's actually, we're at that point and it's going to happen.
Right. So I guess that's good, but for me, that's bad. I don't think I've worn a suit in years since I must have.
I don't even think I can fit in any of mine anymore. I hope no one gets married or dies, because those are the only two reasons I break it out.
Yeah. And most of the time, even when I wear a jacket underneath, it's probably like Philadelphia Eagles shorts or something like that. All right. So let's go back to the regulation, because I know you started talking about that. You've been going to DC a lot, and sort of like, it seems like really making the case to help ensure that the Senate in particular gets market structure right, particularly when it comes to DeFi, which is a very thorny issue. So maybe you could expand a little bit more on what you've seen and heard there.
Yeah, I mean, in our situation, there's three things that we're advocating for. One is around the ability to settle non-currency or non-security transactions with yields as security off a regulated framework, so not having to use an ATS or national market exchange. One is the modernization of the transfer agent rules, where historically transfer agents have been forced to do best effort to get name and address. We think wallet address is sufficient because it's really just a way to drive quorum. But more relevant is the protection of DeFi as a peer-to-peer transaction, not a security offering. And, I think that what I've heard, there's a lot of frustration on the Hill around people coming and saying, oh, this is DeFi, when it, in fact, is not DeFi. There's a centralized actor or player, and they're really just trying to avoid security registration and use it as a shortcut for that. I don't, certainly the stuff we're advocating for, that's not what we're trying to do. We truly do run a peer-to-peer lending transaction marketplace. When I say run it, it's a smart contract that sits out, that's effectively governed by everyone.
It was a, I don't know if Freudian slips the right word, but you say you run a peer-to-peer. It's you created, I guess, a peer-to-peer.
Yeah, and that's that. Yeah, and so we do that at the behest of hash holders, which are that's the utility token of provenance, and they can vote us out of not having anything to do with that protocol to the extent they want to do that. It's we don't own it per se, and the SEC has taken the position that is effectively a protected transaction. It doesn't fall under a securities regulation, but that's the position, right? That's not the law. And so what we need to do is get legislation codified for that protection, so such that we don't lose it in the case that, Chairman Atkins leaves and someone else comes in with a differing view.
What do you see as kind of like the litmus test or the lines of delineation between a true peer-to-peer DeFi protocol and another project or that engages in DeFi theater or stage dressing?
Yeah, I think it's all around intermediation. So if at any point you are touching the transaction between party A and party B, that's not a decentralized transaction, right? So, a true bilateral transaction doesn't require intermediation. And, to a second degree, it's the governance of the mechanism that connects those parties where, if you have exclusivity to that governance, that's also not decentralized because you can change how it works and so forth. So it really needs to be, the community that votes for and controls and administers those smart contracts. And that doesn't mean you can't earn economic off it, right? Smart contract can say, I'm getting 2% of every transaction. And again, the community could vote to modify that or change that. But those are to me the core litmus tests. And again, I think the challenge in DC is you're having to bring a lot of folks up the curve on the education side because they haven't had to think about this in the prior 4 years, and now they're immersed in it. And also, as I said, one of the things I'm really advocating for is giving tangible use cases to a lot of the senators in terms of how DeFi is benefiting their constituents, how it's reducing their loan rates, and the extensibility of that, way beyond the mortgages that we do into almost every type of credit.
Yeah, I don't want to belabor this point, but this is a very hot issue right now, as you well know. Uh, what about voting power? I'm curious, like how much hash or voting power Figure has on provenance, and if you do anything like some projects do to maybe restrict the amount of governance that you're allowed, or the amount of voting power you're allowed to deploy on a particular proposal. And I actually just forgot what my second question was. Oh, yes. Um, some people might be confused how a DeFi protocol that does AML KYC users can also be decentralized. So maybe talk through those two items, please.
Yeah, and the second one's a great question, but let me talk to the first one. So we, as you know, we built provenance, and at one point we had the majority of the token, but in that case it wasn't decentralized. We effectively distributed back to the foundation or burned such that we now have 20% of the token. And my expectation is that we will do a series of actions that burn another 25 to 50% of that. So we're already a minority holder of utility token to the protocol, so we can't influence quorum. But our goal would be to get down, at the 10% level or even slightly below that, not through sales, but through some burning function as it relates to activity that we do within the ecosystem. The second point that you raised, I think people confuse decentralization and anonymity. And I don't view those things as the same, right? So decentralization is, there isn't a single point that is, intermediating transactions or driving the structure or terms of the transactions. It's a community quorum that effectively does that. So I could build a smart contract, but the subsequent management and adjustment of that smart contract is done through quorum. That smart contract could require that you have a KYC certificate in your wallet to participate in that ecosystem. And there's nothing orthogonal to DeFi in doing that. And, and the community could vote to not require that. Again, it's different functions, but I don't think that decentralization and anonymity are the same thing. And too often they get conflated in blockchain and in crypto. And some people feel, will die on that hill. And I just don't think that's the hill to die on.
Okay. No, I appreciate that. Interesting. So let's look a little bit ahead. What's life been like now as a public company? How are you deploying all those funds that were raised? And I'd like to just get a sense from you on kind of what you see as the TAM for HELOCs, but your background as the founder of SoFi is in broader consumer lending. I have to imagine you have a lot of plans and thoughts on ways to sort of leverage the playbook that you've built here into other forms of credit provisioning.
Yeah. So, and a couple interesting points. I mean, one is I think it's great being a public company, and you have to deal with the fact that the market votes on whether they like you or not every day, and so I just don't look at the stock, and I just think about things a very long term time horizon. So, I've been relatively robust in dealing with that.
It's good advice to crypto investors, as a general rule of thumb, anyway.
Yeah. And Jeff, well, I look, Figure is at the very beginning of a long journey. And if you own Figure, you're looking at this as a long-term opportunity, not as a near-term flip. And so, it really doesn't matter what happens to the stock price day over day. It matters, what happens in 5-10 years in terms of our ability to execute into things that are accretive and transformative. And I think we're doing that. And I think that, certainly within the mortgage sector, and especially now that we're competing in first lien mortgage, that's a $3 trillion a year industry. And so largest credit segment in the world. And that one, I feel very, very confident in our ability, especially that sub $300,000 vertical to continue to make inroads against Fannie and Freddie. And, I think it's pretty crazy to think about a blockchain native mortgage company out executing Fannie Mae and Freddie Mac in the first lien mortgage space. But, we've been able to do that. And again, I think we'll continue to do that. But philosophically, and I'm glad you brought up SoFi, because, when we built SoFi, we thought a lot about the super app construct, right? And the whole value is cross sell. We get this customer in, and they're super high value, and we're going to be their lender, but we're also going to be their banker and their broker and their wealth manager and all these other things. And that's certainly the extension that Robinhood has taken in their ambitions to be super app. And I think, Coinbase announcing stock trading yesterday, albeit, in the old antiquated way, not the new cool way. Everyone wants to, or a lot of folks want to migrate towards that super app. I've taken a different philosophical approach that, we'll talk more about as we get into 26, which is, I believe that rather than the centralized construct, I think it's self-custody wallets and distributed applications. And I think, you and I will carry all the relevant information we need, whether it's our assets or liabilities, our identity or KYC, what have you, in our wallet. And we will choose what venue we trade equity on, what venue we trade crypto on, what venue we borrow against assets, what venue we lend against assets as distributed apps. And so, what you really want to do is build some combination of the best wallet experience plus the best D-app experience and compete in that vertical, recognizing that you don't have this control of the customer anymore. The customer is going to have this ability to exercise democracy in terms of where they go. But to do that, right now our wallet experiences in crypto are not great. And they can be very intimidating. They can be very non-intuitive. They can be very cumbersome. And so, I think there's some work that needs to be done around the wallet experience. But, the idea of taking my wallet, attaching to a DEX that's trading securities, could be an alternative trading system, and not requiring an introducing broker, right? Not needing Robinhood or Schwab to use that account to access the marketplace, but just access it directly with my wallet. That's a very powerful introduction and disruption to the market. And that's one of the things we're pushing hard on in terms of our equity offerings is allowing such market access. And we think that's a precedent that other companies are going to follow behind us on.
Gotcha. All right. So as we get ready to wrap up here, I wanted to get your sense of, just broader tokenization landscape. I forget how big it is, like outside of just stable coins, but there's stable coins. There's money market funds, there's treasuries, now there's stocks. As I'm sure you're well aware, there's a few different credit, like structured credit funds that have also been tokenized, I think, from some of your own business partners. Like what do you make of all this? And I know you mentioned before you have some lessons learned that from your own experiences and from what you've seen other tokenization projects do that didn't really get that escape velocity. Like what do you think needs to happen for all the hype to sort of really manifest itself properly this time?
Yeah. So look, I think thus far, I would argue, and of course I'm biased in saying this, that there really hasn't been a lot of successful tokenization of RWA other than what we've done in the consumer credit side. And the reason I'm saying that is, you can look at a Biddle, for example, and okay, Biddle has, I don't know, $3.5 billion of AUM in it right now, which as a money fund is insignificant, right? You don't make money in a money market fund until you have about $100 billion of assets. And so, it's just not a material thing. And, like Apollo's ACRED, well, there's a couple $100 million in ACRED on blockchain. Well, that doesn't even begin to move a needle for Apollo, right? In terms of what that is. And I think what a lot of people don't realize, and kind of going back to those three value props I talked about earlier, for Figure to get loans on chain, we had to leave a lot of money on the table along the way. So we had to have a long-term perspective. So in the beginning, the hedge funds that came to us to start buying loans said, hey, I'll pay you more if I don't have to deal with blockchain. Literally, they would have paid me more money per loan if they didn't have to deal with the blockchain. And I'm like, the only reason I created a lender was to get you guys on the blockchain. So no. And, at one point, one of the big insurance companies came to us and said, I will pay you more if you underwrite to my underwriting box, not to the market underwriting box. And we said, well, that's going to get rid of the homogeneity of the asset. That'll impact liquidity. No, we're not going to do that, right? We're going to get paid less and we're going to do what we're doing. Because we knew at some point we'd hit the inflection point where blockchain was actually an asset, not a liability. But the reality is, when you start off right now, it's a liability. There isn't this panacea of money on blockchain that you can't get to anywhere else. Money is really smart. It can get to whatever it wants to. It doesn't need the blockchain to do that. And so in the beginning, you're introducing something different that introduces friction. And so, in the beginning, it isn't that it's cheaper for me to finance XYZ on blockchain or trade PDQ on blockchain or whatever it might be. It's actually, in a lot of circumstances, going to be more difficult to do it. But in the long run, it will make sense, right? And for us, we hit that inflection point, a year and a half, 2 years ago. And, our third quarter numbers, we did 160 million of revenue or somewhere in that neighborhood, but we did $90 million of net income. And, that net income margin was because of blockchain efficiencies that weren't there 3 years before, right? And we only expect those efficiencies to get bigger over time. So, that's the challenge that you've got. And there aren't a lot of projects that can lean in and commit to leave those dollars on the table up front, over the course of 2, 3, 4 years to get to that inflection point.
Gotcha. Love to know the names of those firms that tried to pay you more to not use blockchain, but I'm guessing you will not disclose those names.
I was very particular not to, and that was
if either for competitive reasons or to save them the embarrassment. All right. So to wrap up, I'm just any final thoughts, big plans, expectations for 2026 that we haven't talked about yet?
No, I mean, look, the big one is getting Figure Equity on chain, and I think we'll have some fast followers of other companies behind us, and true blockchain native securities, no DTCC, trading on DEX, finance through DeFi. I think this is the future, and we're taking everything that would be able to prove on the credit vertical, and now we're extending that into the equity vertical, and that'll be one of the big focus points for 26.
Gotcha. All right. Well, Mike, thanks for joining me on Bits and Bips, the interview. We'll have to have you back sometime next year. And thanks to everybody for watching and listening. And Mike, thanks again for joining us.
Thanks for having me.